So here we are. The debate is this. How far will this bond repricing go? Is it real inflation? Is it a real momentous change? Martin, good morning.
Good morning, Manus. Good morning, Anne-Marie. We could easily see 2% 10-year Treasury yields. That will not be troublesome for the equity market. But we could see 3% 10-year yields by the middle of the year. But 2% is probably doable before Easter.
You're saying 3% by the middle of this year, 2021, Martin?
Correct. And the reason is very simple. You just mentioned the Nobel laureates, the academics, Krugman and Stiglitz. We'll add in Larry Summers. And this goes back to basically core policy. We have no brakes on policy. We have the J&J show. Jay Powell and Janet Yellen. Monetary is on full acceleration. Fiscal is on super acceleration. So what gives? And that's where the bond market comes into play. And this goes back historically to taking away the punch bowl from Bill Martin in October 1955, Bob Rubin with Clinton in 1993, where Clinton was forced to hike taxes, and Bernanke with taper caper in May 2013. So there's a lot of historical precedents here, but the bottom line is we have no brake on policy. We have super monetary, super fiscal, and this is the big change that's happened in the last 4 weeks. Nominal GDP in America for this year has been upgraded to 7%. The budget deficit has been upgraded to 12%. This is a super economy. And the only break can come from a market discipline, which is interest rates going higher.
OK, so let's extrapolate forward, Martin. Do you think that the Fed could even allow rates to get to 3%? And would that cause a huge break on this melt-up in assets that we have? Let's deal with Section A. Would the Fed even allow rates to get to 3%?
Well, the Fed has sort of no choice, because you mentioned already, you know that basically in Europe and in Japan we have negative policy rates. We're close to 0% in the UK. We're close to 0% in America. We don't have negative policy rates in America, but we had for the last 1 to 2 years negative interest rates in America. We had a negative long-term real rate. We're just about to pop positive. It's gone from -1 to 0%. And we had a negative 10-year term premium, and that was almost -1, and that has popped positive to +20 for the first time in 2 years. So long-term interest rate structure in America is the release valve. We have no release valve on monetary. Jay Powell, unlike 1955 or Bernanke in 2013, is refusing to countenance any type of tightening. And clearly you can see that Yellen at the start of the new administration has basically decided to do 10, 12, 13% deficit. So the deficit doesn't start with the American Rescue Plan on March 14. It'll continue later this year with an even larger American Recovery Plan.